When the markets get noisy like this, Carl, it's really important for us to always examine the base case. What's the base case? Begins and ends with the U.S. economic resiliency. What do we know about economic resiliency? The consumer is super strong in the second half. Retail sales from last week. U.S. GDP this quarter, maybe 4%. That will be the strongest in 5 years. And U.S. corporations are on track. We've been measuring small business confidence for 45 years, second highest reading in consumer confidence. So the trade worries are not yet factoring into confidence.
Well, smart.
But the tail risks from the beginning of the year have increased. What are the two tail risks? First is trade. And it's not really the $50 billion that has been announced. That $50 billion is, I think, 0.3% of U.S. GDP. It's the escalation. It's the uncertainty that would cause companies to then pull back in their spending, right? So that's not there yet. Jerome Powell continues to validate this economic expansion, and job openings, highest since 2000. So folks that are looking for a job can find a job. And then the other tail risk would be inflation. And Jerome Powell again is saying inflation is not really a concern. But they have increased from the beginning of the year, which has caused us to take down our equity allocation a little bit.
Jeff, one way of looking at this is to say, hey, the people who got negative too soon have lost out on the markets continuing to perform really strongly. But then another way to look at it is, boy, a lot of these trade concerns maybe aren't priced in, and that could be a concern. Which way do you lean on this, Jeff?
Well, I think you have to break it down between the economic impact that Phil just talked about and the stock market impact. Clearly, stocks are not yet pricing in the escalation into a trade war. Look, from an economic perspective, right now we're looking at the dollar amount collected of tariffs as a percent of imports, 1.4%, the lowest in 200 years. If everything Trump has talked about or threatened is put in place, that would jump to 5%. That's still well below the 20% during the Smoot-Hawley era that viewers of Ferris Bueller's Day Off will be familiar with, but it still could be economically damaging. The difference is, for the stock market, it's devastating. We've got more sales tied to international trade than we've ever had before, particularly in areas of leadership for the markets like the tech sector. That has not yet been priced into the markets. Having said that, though, that's hopefully not where we're headed. Maybe signs this morning between the offer by some of the German automakers is a sign that over the next 2 weeks, ahead of the July 6th implementation of these new tariffs with China, that we will come to some sort of resolution. That is the hope.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.